The time has come to opt out of the imploding fiat money system. We have the power to do it.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Art and gold, in some ways, very similar. Both beautiful to look at, both appreciate in value over time. But just how art can sometimes be forged, there's a darker side when trading gold and silver. Find out why gold ETFs are not all what they seem. Click the link to find out more. Welcome to this very special edition of Live from the Vault. Now, you may wonder what I'm doing standing here in a beautiful art gallery in the middle of the Cotswolds, talking to Stephen Beale, the founder and proprietor and owner of this beautiful premises. Today, thanks to you, we came here to actually tell the story about illusions in gold, about paper golds. We've been doing a lot of work on the exchange traded funds, which are really an illusion. Here, I can come along and I can see that piece of art. I can see I can buy this and I know I have it. I know that all the energy that went into making that has no counterparty risk because it's been done. You have so many beautiful paintings in this lovely gallery, rooms and rooms of them. What can you offer people if they come to see you?
At Trinity House Paintings, we specialise in Impressionist paintings. We do go into modern British, so artists such as Claude Monet, Alfred Sisley, Pierre-Auguste Renoir, to modern British, which would be Lawrence Stephen Lowry, Ivan Hitchens. So we go out for quite a wide plethora of time period. For about 200, 250 years we cover. We exhibit worldwide. So our clientele who keep coming back to Broadway, if they can't come, we go and visit them. But it's really blue chip names, really the top echelon of the art world and art market that we focus on. We're starting to bring through the new artists, so we do have a contemporary side of the business.
I want to thank you so much for even allowing us to come in here and shoot our expose of really the ETF fraud in your beautiful gallery here, where we're surrounded by beautiful physical products, which are paintings, and you've spent all day here. Your staff's been put out, but no, you stood by us and you allowed this to happen. And I really want to thank you so much, Stephen, for really all you've done for us.
Thanks, Andrew.
I'm Andrew Maguire, British commodities trader and whistleblower, exposing the corruption and the manipulation in the gold and silver markets for the last 30 years. Now, to explain what's really going on, look at this painting by Belgian surrealist artist René Magritte. Underneath the pipe, it reads in French, "This is not a pipe." And what the artist is telling us, this is not a pipe. This is a pipe. Kinesis only sells you gold and silver backed one-to-one, fully allocated and fully redeemable at any time. Unlike gold ETFs, where you don't own the underlying asset. Do you really know what you're trading? Or is it just an illusion?
Wow, Andy. First of all, I didn't know you were a magician, and secondly, you know, Andy, I watched that, and what I'm we've done over 100 episodes now, 100 episodes of Live from the Vault, and one commonality is you keep on talking about the difference and between the fake and the real, the paper and the physical. I love that little spot there, and maybe you can give us some insights on what it took to put all that together. That's a beautiful piece there.
Yeah, and I think, I really also have to thank Stephen Beale and the whole team at Trinity House Paintings in Broadway. I mean, they made their gallery available for us. And, we've got a world-class Kinesis team and, award-winning team. And I often pop into this gallery and you never know. There's A-list celebrities in there. There's everyday people exchanging their depreciating pounds and dollars to take possession of original art. Anything real. And I think this is the message we're saying. ETFs are an illusion. You think you own something you don't have. So we thought it was a great analogy, so to speak. But Shane, it's nice to see you again for this next episode. So much to talk about here. So looking forward to it.
All right, Andrew. Now, in our first episode of 2023, you drew a lot of attention to a massive escalation. What a beautiful way to start this episode here, because you're talking about the long-standing paper to physical battle. It's more like a war happening, and why we're going to see much higher physically driven prices this quarter. Now, you broke the news on this largely unreported. We talked about this. Why wasn't anybody reporting this story? And we've had a ton of subscriber questions since that episode. And can you just, first of all, let's get started with this episode by bringing us up to date on this very bullish development.
Yeah, Shane, great to see you. And yeah, nice to see you in the beautiful tropical paradise. I've got all my woolens on here. It's very cold out. But anyway, well, it's nice to have a contrast, isn't it? But Shane, yeah, you're right. We've done a lot of work on this since then. So to update our reports, really, that Russia and China had begun weaponizing the very large physical gold reserves that they own. And these reports we've been receiving since then on how this trade is expanding is now spilling out intermittently through global news reports, illustrating that the other friendly jurisdictions, including the BRICS Plus countries, are increasingly adopting the Russian gold-backed stablecoin announced by Russia's Sberbank on the 2nd of January. Now, the increasing adoption of a gold benchmark to price all commodities is what is driving a physical gold price higher, offsetting any bouts of returning dollar index strength. Now, that is a change in behavior. Now, aside from this game changer, our mainstream media reports on the potential wider integration of emerging market currencies. They're seeking to iron out the inherent high volatility against the dollar, while creating baskets of fiat currencies. They're discussing that, but that's pegged to $1. And it's really just a diversion and inherently flawed, as they do not provide the ability to fully opt out of an increasingly weaponized dollar. However, adopting gold as a benchmark to create a basket of gold-backed currencies would enable a diversification of these reserve holdings, allowing these jurisdictions to gradually opt out of the increasingly weaponized SWIFT payment system. Now, while we're seeing several concurrent efforts to form a basket of fiat-based BRICS currencies, they're doomed to fail. I mean, they're going to fall by the wayside as as this common gold-backed currency becomes the only sustainable alternative benchmark price for commodity trades between nations. Now, originally, the BRICS Plus move to de-dollarize was estimated to take at least 5 years to gain sufficient traction to impact the dollar trade. People were saying, yeah, it may happen, it may not happen, it's going to be 5 years down the road. But following Russia tokenizing physical gold at the open of New Year's trading, liquidity providers report the adoption of gold to price the multi-billion-dollar energy and commodity sector. This time, it's going to significantly, obviously, it's going to really create this huge change in pricing. Now, potential liquidity to drive adoption of tokenized gold. So if anyone's doubting, there's not enough liquidity. No, the global oil and gas markets alone are worth $7,500 billion. Then add in the 5,000 billion commodity and energy sectors, and the scale of gold adoption becomes clearer. don't think people have thought this through yet. We're currently in meetings with our well-connected first-tier liquidity providers to better assess how this will translate into a real physical supply-demand price and on what timescale. But what is clear is that the inherent Western cartel paper gold derivative game is going to implode, and we're gearing up for it. And we discussed in our last episode, what is patently clear is that the so-called LBMA professional trade got truly blindsided on the first trading day of 2023, triggered by the surprise move from Russian Sberbank reporting it had been licensed by the Russian central bank to tokenize physical gold on their proprietary Stellar blockchain. Now, the objective is to benchmark a physical gold gram price for a wide range of physical commodities. And as I say, the potential scale of this, I've just outlined the potential scale of this, but what has just been sprung on the LBMA CME ring fence is just the thin end of a very large game-changing wedge into which a real physically settled price, much higher price for immediately deliverable gold will emerge. They're not talking about deferring it in derivatives. This is physical gold backing every single gram. And it will increasingly be determined by real physical supply demand fundamentals, which we've just outlined the potential of. Now, while blinkered Western analysts, they're desperately trying to interpret the gold rally from last November's lows. They were attributable to the Fed turning less hawkish. Well, of course, it was helpful in so much as the led-by-the-nose CTAs, if you remember the CTAs, just the professional traders, we call them the specs, basically, and they started short covering and going long paper gold. But historically, these CTAs were also being set up by the cartel for a New Year rinse of these non-deliverable futures positions. And this was quite evident by the rising casino-centric bets against these paper long positions. So that's the one good thing you may see the COT report for, although it does not show the other side of the picture. However, the New Year gold weaponization move by Russia completely wrong-footed these large derivative short bets that were being set up by the cartel, catching the cartel offside, basically, forcing them to scramble to short cover. Now, the rapidly changing option structure, this is the derivative structure, provides a really solid clue that very large, hidden, bilaterally settled derivative bets that are attributable to these option structures are severely offside for the cartel. Now, recall how persistent LBMA cartel short seller was Toronto Dominion Bank admitted it had misjudged these bets, which were betting on lower gold prices into the end of the year. And they were caught offside on these at-the-margin leverage trades, which relies on the fact that COMEX-centric CTAs never take physical delivery, so they can be led by the nose to act in unison. However, the fresh uptake of physical gold at the margin forced house short covering. There's leverage there. They were wrong-footed by, as they put it, they were saying, who in the world is the mystery buyer driving prices higher? This is, of course, before they realized that this was Russian and Chinese central banks, but it was the gold commoditization move that really neutralized their plan to rig gold prices lower, which they were set up to do. Now, given the scale of the strong rebound in the dollar index at the open of the year, and as we opened the year trading, the dollar rose, but gold simultaneously rose through the top of the chart painted ranges, rising alongside the dollar index. This long-standing inverse dollar to gold trade tool imploded. In other words, whenever the dollar was going up, the HFTs would come in and sell gold, tick for tick. Now, if you recall, we, along with some of our live from the Vault guests, like Dave Kranzler, were anticipating a strong rally setup similar to 2008, which was the last time we saw safe haven gold rising alongside so-called safe haven dollars. Now, despite every effort by the cartel to try and call a top and to incentivize the led-by-the-nose CTAs to assist in swamping these physical-driven upside moves with paper gold, leveraged paper gold, gold held up extremely well, with every single dip being jumped on into the usual gamed Fed gaming events. Why is the question? Because Basel III compliant gold was being drained out of the LBMA CME swamp at every fix. Now, this unfactored physical gold demand has continued and has sent a wave through the industry as other international banks and jurisdictions now begin to embrace this physical de-dollarizing solution. The lion's share of raw commodities are in control of Russia and the BRICS alliances, sufficient to dictate the price of these commodities in physical gold grams.
Yeah, once again, Andy, we're talking about the physical, almost like the illusion versus the physical. Now, in our last episode, again, you indicated that in particular, silver is going to enormously benefit from the adoption of physical gold. And you gave the reasons for it. So if you're a viewer, you haven't seen that, go back to the last episode. Andy went through that. But can you bring us up to date now in the last couple of weeks? What's occurred?
Yeah, Shane, and I knew silver would come up. This is where it gets really interesting for silver. What is not yet fully realized is that silver is just one or more of a wide range of commodities. Or obviously it has a monetary side, but there's a commodity side. But albeit the most undervalued of all commodities, which I think nobody even ever disputes that. So what's going to happen is silver will be increasingly be benchmarked to physical gold grams. This is a huge deal. The resulting de-dollarizing of the largely netted out, cash settled LBMA silver fix undermines the so-called professional silver trade, exposing the extremely vulnerable 100-to-1 cash settled market to become physically deliverable, priced in gold grams. Think about that, guys. That is a change in how you price a commodity. This has drawn unwanted attention to the paper-centric gold-silver ratio. Now, people who don't know about it, there is a ratio between gold and silver. Now, obviously, a lot of traders understand what that is, but essentially, what it illustrates is the difference, the leverage in how much silver it takes to buy a gram of gold. And this week, really taking advantage of the thin the conditions while China is absent due to the lunar holiday, insiders desperately capping silver at options derivative bets ever closing above 24 now we're recording this on Wednesday, and tomorrow's Thursday, and that's options expiry. So what they did was they'd been capping 24, desperate to keep this level from closing on Thursday. Now they managed to walk spot silver almost $1, and in fact a full dollar down to tag $23. I mean, this is ludicrous. Silver is in massive Indian silver demand. And what they were doing was simply targeting, old game here, targeting visible CTA long stops, which they have on their books, at very obvious 50-day moving average. We know that these big moving averages always hold stops, whether it's on the upside or the downside. They targeted them at any cost. And the CTA long stops at the 50, well, of course, we said, you know what, because they're going to just be two-way rinsed. And sure enough, because it drove the ratio trade, the number of grams or ounces it takes to buy a grams or ounce of gold to actionable extremes. So the obvious, because you're looking at the way a difference in how silver is going to be valued in gold grams. Now, the obvious gamed test and two-way flush of this 50-day moving average, it put silver about 90 cents below the very strong option support, which is around 23.5 to 23.8. Any surprise that we're seeing it gaming around that level now? However, liquidity providers reported that insiders were pushing the ratio trade envelope to extremes as gold rose into these fresh gold highs, which we've seen again and again, day after day. We're seeing fresh gold highs. This indicates it's the momentum CTA specs who are being tricked into taking the short load, and the insiders are 1-to-1 long against them. So while very short term, using utilizing momentum from the led by the nose specs. The group of naked short traders may get further wrong-footed into options gaming, very short term. Selling silver into a very strong gold market is driving the connected ratio trade to extremes that liquidity providers assess will force the commercials to take the long side of silver above 80 to 1. Well, it's above that right now. In the attempt to keep paper silver from closing above 24 on Thursday, the ratio trade was driven as high as 84 to 1. I mean, that's ludicrous. 84 ounces of silver to buy 1 ounce of gold. However, the Indian buyers are all over this trade, scooping up paper silver and converting it to physical. They know this game, and they're savvy buyers. What is most important to understand is that increasingly silver, along with all commodities, is going to be priced in gold grams. This is a huge risk for the old guard 100 to 1 so-called professional trade, who by the LBMA's own admission relies on this highly leveraged paper netting out structure, which involves very little physical. So very short term, options is tomorrow. Okay, so we know that we're recording this on Wednesday. So we have thinner conditions into the Chinese holiday. The paper options fight at 24 silver is continuing and it's underway. However, as we discussed in our last episode, COMEX CTAs may get further wrong-footed into options expiries, but selling silver into a very strong gold market is driving this connected ratio trade to actionable extremes. And I really strongly suggest people look at that ratio. Liquidity providers assess moves above 80 to 1 is really going to force the commercials to take the long side. So that is what's happening. Guess who's getting wrong-footed here? And the battle at 24 is stretching this to extremes as silver begins to be alternatively priced in gold grams outside the LBMA 100 to 1 ring fence.
You know, Andy, that's amazing. 84 to 1. You know, people always ask me, why do I buy silver? Exactly what you just said. You know, historic, slash CME ring fence that you talked about is finally being breached. What are you seeing in this larger picture right now?
Yeah, Shane, stepping back to look at that larger picture, this unprecedented move to tokenize gold to price commodities has undermined this automated inverse dollar to gold high frequency trading bot, which has over the years been the very tool to directionally lead CTAs to short sell foreign exchange gold tick for tick against every rise in the dollar. Now, I cannot stress just how significant this change in behavior is, because it is a tool that is being removed from the old guard. The old guard disconnect into this strongly rising dollar index at the open of New Year trade really spooked the LBMA CME, so-called professional trade. We have had a lot of feedback about this. Yes, we've seen the dollar coming back off since then, but it was the move. It was, as we talked about, Kranzler talked about it, we talked about it. This is very similar to what happened in 2008. But since then, Basel III NSFR regulations have forced the over-the-counter leg, i.e. the spot side leg, of the deliberately imbalanced COMEX-centric casino spot to futures. And we talked about this asymmetric trade, which is basically taking a deliverable at Basel III contract and then leveraging it higher on the COMEX with paper. So in other words, hence an asymmetric trade. Insiders have relied upon gaming this smoke and mirrors futures leg of these imbalanced trades. That's been the game. Now, however, there are limitations, as this paper to physical demand situation can only be rigged to the degree as to how much projected naked short CTA short cover, or getting them to capitulate their longs, can be sucked into for the house to cover into their shorts at these paper-centric prices. Now, this trade relies on the CTAs, many of who have no mandate to hold any physical assets, to never take physical delivery. This asymmetric long over-the-counter short futures envelope has severely contracted, as evidenced by the resulting drain of LBMA gold stocks which have reached reportable extremes. Now, the drain in LBMA gold bullion holdings has been impossible to hide, forcing the likes of LBMA kingpin, JP Morgan, to begin to break rank to compete with UBS and Credit Suisse to clear physical trades in Switzerland. Switzerland being the primary transit hub between Eastern and Western precious metals markets. Now, we see this as a defensive move by another first-tier LBMA bank, market-making bank, I will add, who since Basel III NSFR standards were imposed have moved full-on long physical gold for their own books. Now, this is another crack in the old guard cartel, who for the last 50 years were collusively, directionally net short gold. Now, we're evidencing a reversal in this stance, which is forcing a real gold price to slowly emerge. Now, the BIS led the way and is positioned accordingly. We talked about that last year. Now, very short term, it's obvious that there's been a concerted effort by the insiders to try and reinstigate this directional dollar index gold algo tool, have every single leveraged paper-centric dip into a rising dollar index has evidenced these so-called asymmetric short futures positions in draining the physical that's underpinning these imbalanced trade. This is an impossible to escape catch-22 because they do not control the physical side of this market anymore. Now, the major West-East split is something that is yet completely off the radar for most non-delivery blinkered futures market participants. What flies under the blinkered CTA radar, but explains why gold is actively being scooped up in the global physical markets, is this deliberately underreported strategic move by Russia to weaponize gold is now being recognized by the cartel as the front end of a plan to de-dollarize the trading of all commodities using physical gold to value and settle these transactions. Tokenizing 5,000-year-old physical gold is the optimum way of doing this, and it's time to be long undervalued gold. This is a structural change in behavior that is far bigger than is generally realized or priced into the derivative markets, and once more places the deliverability of Basel III NSFR compliant EFP, that's exchange for physical positions. Remember, that is just simply the house in the casino has a transitory mechanism called an exchange for physical, where you can actually take that into the spot market, which is deliverable. It's placed that at risk. And as we've illustrated multiple times, this EFP is the COMEX Achilles heel. Any attempted removal of this conduit, which they'd love to shut this down, but it would completely expose this imbalanced, long over-the-counter short futures asymmetric COMEX trade, forcing the next leg of a real physical price to emerge at a trigger point and without warning. Just remember, the sudden March 2020 $100 spreads per ounce between spot and futures, guys. It's like, people have forgotten about this stuff, but what we're talking about, it's at the margin. This is exactly the kind, we're talking about a physical market that the cartel is losing control of. The cartel, they simply have to keep this EFP conduit open, and this week's outflows have been significant. Around 190 tons since the beginning of January trading, around 190 tons of COMEX gold has outflowed since the beginning of trading on the 2nd of January 2023, and silver has also evidenced about 1,400 tons EFP'd. This is in addition to direct loadouts, which is people pulling up at the COMEX vault and demanding delivery outside the vault. In addition to that, so the PBOC and Russia's central bank, who stepped up gold buying ahead of last year's Ukraine military operation, have for their own reasons been hedging and positioning against a growing distrust of an increasingly weaponized dollar index. Now, a US dollar, and you don't think China's thinking about this? You don't think the BRICS nations are thinking about this? Talking about Saudi, talking about buying gold, oil in other currencies. You don't think they don't feel that this could be weaponized against them? And as we've just outlined, though, Moves to de-dollarize are also spilling into the BRICS plus currencies, also seeking to hedge these foreign exchange disruptions, which could be instigated at any time. The PBOC and Russia's central bank. Really, as we touched on in our last episode, I'm not going to go on too much about it, but this strategic move by powerhouses, Russia and China, to de-dollarize has necessitated them producing, buying, and taking delivery of thousands of tons of physical gold, much of it transacted off-grid through third parties, and a lot of it has spilled out of the LBMA ring fence. The bulk of these flows remain unreported as yet, given there is only one global supply of physical gold on offer at a deliverable fix. At the margin, this exacerbates the drain of LBMA physical gold underpinning this imbalanced asymmetric trade. It's going to force banks who have been traditionally bet against gold to reverse their naked short positioning. Every single first-tier bank we've researched are betting on higher gold prices and are positioning accordingly for their house accounts.
Now, Andy, you mentioned other mandates to de-dollarize. They're springing up like in various forms. Some to succeed and others to fail. Like, what are you seeing in this area?
Yeah, since we began to drill into this largely unreported gold weaponizing story, the reports of this trade expanding to other jurisdictions is starting to spell out. Information that Iran has also been exchanging oil for gold, utilizing the Russian gold-backed stablecoin to create a jointly held stablecoin. That is being going on and it's being formalized. Last week in Davos, Saudi Arabia raised the subject of trade settlement in currencies other than the dollar. The oil for yuan trade was acknowledged by Mohammed al-Jadaan. He was interviewed on Bloomberg. I couldn't believe it when I saw this interview. No information yet. We don't have any more information on this Saudi trade yet, with other friendly nations, which include Russia. But this is going to evidence the oil being benchmarked to digitize gold. And ultimately, that is the only way it can be priced. But given reports of the gold trade picking up steam in other jurisdictions, this is increasingly likely. Recall Credit Suisse Pozar predicting this? Brilliant he was. And absolutely, he was well ahead of the game. We should have more information on the real scale of this gold tokenization from our very well-connected liquidity providers very soon. Now, it's not escaping the LBMA cartel that other jurisdictions, both commodity exporters and importers, are also interested in settling commodities benchmarked to physical gold. Lots of unofficial transactions are slowly coming to light, such as the relatively small 40 million of oil shipments to Ghana were paid for in gold, with the objective that ongoing oil purchases will also be paid for in gold. This is expanding everywhere. This is designed to prevent the exchange rate, of course, for a country like that, from directly impacting fuel or utility prices, as the domestic sellers would no longer need foreign exchange to import oil products. So this is like a big sidestep. And we also highlighted in our last episode, and subsequently confirmed by our liquidity providers this week, they're getting reports of a massive oversubscription of the new gold for commodity benchmark. And as liquidity expands, and we talked about the potential for this liquidity, we should continue to expect a fresh, physically driven rally in gold prices to follow. This continued this week with gold making a fresh high again yesterday. At the margin, each ounce of physical delivered bullion leaves the ring fence exposed to paper trade, really exposes the paper trade to an inverse reverse leverage unwind, exposing real supply demand physical price. Hallelujah. And while the official line is that cryptocurrencies will be fully regulated in Russia sometime in 2023, yeah, that's the line. What is missed by the reporters is that digital gold purchased on the open market, digitized on the Russian central bank regulated bespoke Stellar blockchain, are not really cryptocurrencies at all. they can just be expanded upon to the degree of downstream physical gold demand. This is just the utilization of 21st century blockchain technology to audibly digitize 5,000-year-old physical gold, with a bigger plan to use this gold as a benchmark for the price of all commodities in gold grams. Hey, isn't that what Kinesis is doing?
Yeah, Andy, I was just thinking the same thing. It's like, did we think of this before they did? But amazing. That just shows the brilliance behind the Kinesis team. But you also mentioned, though, how tight the physical silver market has become. And I'd like you to share more information on that.
Yeah, capping silver into such strong related gold demand, silver has made silver vulnerable to an LME type nickel short squeeze. You remember we talked about that, especially as we're now evidencing SLV short interest at record high levels following intense paper centric capping at 24. This is desperately trying to contain this level. Interesting to note that Trafigura, the very same entity that got bailed out by the LME nickel short squeeze, has been busy taking delivery of large amounts of copper while closing off warrants. And as they stated, to ensure we can actually continue to supply our customers with the metals they need. Yeah. And this scramble to cancel large holdings of copper warrants are fueling concerns about physical supplies at the LME. Now, it's been reported by Bloomberg. Copper and silver over-the-counter ebbs and flows are entwined. The 100-to-1 paper leveraged silver trade is widely considered to have resulted in silver being cheap relative to all other commodities. Now, the LBMA trade is now under threat into a rising gold price, where gold grams will increasingly benchmark the silver price. Now, a short squeeze in copper portends a physically driven short squeeze in silver, likely also beginning a stealthy exit of NSFR compliant silver warrants. Nevertheless, if they become demanded for delivery, and it's happening in other jurisdictions priced in gold grams, watch out. As we've indicated, while China is the largest exporter of silver to India, China is also a very strong buyer of all denominated commodities, including physical silver. So looking at the option structures, because most people want to know, look, we've got some technical guys, we also got some traders. They want to know, and again, you'll hear this on Friday, this will have passed, but looking at the option structure for tomorrow, which is Thursday, following this week's actions, really kind of reveals that for gold, massive, they're in massive pain against bets made to cap 1900. These are rapidly unwinding, but once 1950 is breached, large stops, short stops at 2000 will be exposed. Spot gold is consistently evidencing very strong physical demand at every single fix, spooking the wrong-footed CTAs, who themselves have been wrong-footed into every game dip, into waiting spot buyers at the round number. So any drip down to this area has just increasingly forced buying. Bottom line, physical gold demand is very strong, forcing CTAs induced into capping to cover into these very wrong-footed options bets. So most liquidity providers see spot gold as ranging somewhere between 1900 and 2000, but as we said last time, with 2400 looking magnetic. Now in silver, these bets against 24, these ludicrous bets against 24 are still embedded. Large short stops sit at 24.5, which explains why every attempt that silver's gone to that level, they've capped the hell out of it, taking huge amounts of short sales just to do so, only as soon as they wait for the silver fix. Then they take it down, and then what happens? It slowly comes back up. I mean, it's just really a rinsing exercise. But as we had assessed last episode, while we once again evidenced capping attempts at the equivalent 24 spot level, it was interesting to note that we've seen bouts where both spot gold and silver began rising in tandem into certain upticks in the dollar index. What it was doing is reflecting safe haven demand is valuing physical commodities. So in summary, due really to the lunar holiday thinning out paper liquidity, due to the retail trade absent until next Monday the 30th, the wholesale trade and central bank activity will continue. Now, we may continue to see the cartel attempts to capitalize on thinner liquidity, but liquidity providers are expecting much higher prices this quarter and report really lots of underlying spot bid interest. Now, for the many people that study the COT report, we get questions about this. We just have to respond to it. As highlighted in our last episode, the move by Russia and China to tokenize gold severely undermines what little value the one reported leg of this report has. And what is happening is that the hidden Basel III compliant deliverable over-the-counter leg of this report is eating into the leverage futures leg of this report. So don't take it at face value. With US gold demand suddenly reignited as the price rises, it will be interesting to see how the deliberately unpublished, hidden over-the-counter legs of these published COT hedges begin to reflect a rapid unwinding of these paper-centric positions as they morph into representing a real higher deliverable gold and silver position. So next week should be very interesting. The option structures are beginning to reflect a very wrong-footed derivative trade that is in the process of being squared. So really, the time has come to opt out of the imploding fiat money system. We have the power to do it. It would not surprise us to find that blindsided Western governments double down on weaponizing the dollar for any reason that they can come up with. But we have the ability to take back control of our rapidly eroding wealth. The only question that remains is just how much physical gold and silver do you own? Come and explore opt-out solutions at Kinesis. Look, timing could not be more perfect. You've got nothing to lose, guys.
What an appropriate way to end. Thank you, Andrew Maguire. And it's kind of interesting. You started off with the magic trick with the gold. That was kind of cool. And contrasting real art versus fake art versus illusion versus reality. It's all tying in together. What timing, Andrew Maguire. And remember, to our entire Life from the Vault community, buy physical and make sure it's 1-to-1. Understand the difference between what Andy always and affectionately calls the casino paper, gold, and silver markets, and the actual physical gold and silver markets. They're not the same. Don't be fooled. It's an illusion. And there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. I feel like these first two episodes, I had to fasten my seatbelt a lot tighter than I normally have it on these shows. But please help us keep spreading the word about this channel. Hit that like button, not now, but hit it right now. Share it with everyone you know. This is an important time in history to be learning about this if you're just learning. And for those that are more seasoned, you know exactly what's happening here thanks to this show. Click the bell if you'd like to be notified as each episode goes live. And with that, we will see you next time right here on Live from the Vault. See you then.